And so think about this. This is where it gets really exciting. Without Lisa increasing her income $1, without reducing her expenses a penny, just from doing tax planning, she's going to have almost $35 million available to her for retirement just from investing her tax savings. And so that's the power of tax planning. It truly is one of the most impactful things you can do in your business. One of your largest expenses in your life is taxes. And so what I want to focus on today is helping make that amount that you have to pay go smaller. And that's by doing a really, really important activity called tax planning. Now, I may be a little biased, but I think it's a pretty cool thing. I know people don't think taxes are that sexy, but saving $100,000 and $200,000 a year starts to get pretty sexy, right? So with tax planning, it's this really cool activity where you make your accountant a profit center for you. See, most people think the time of year to meet with your accountant is tax filing time. That's actually the worst time of year because all we're doing is we're that accountant that I mentioned at the beginning. They're just filling out the forms. You see, the best time of year is before year end because we can actually meet with you, review your numbers, calculate what we think you're going to owe, and then give you a list of action items to actually lower that tax bill before the end of the year. So that's what is super critical with tax planning. And to kind of highlight the power of it and the importance of it is a couple pretty alarming statistics. So when we look at all the clients we've met with over, thousands over the years, between everything I've got from social media and we're at the Tony Robbins events that I'm, participate in. When we look at all the clients we met with and what they were paying in taxes before they met with us versus what they could have been paying if they were doing everything they can to pay as little tax as possible, 97% of clients either overpaid tax or were structured incorrectly from an entity standpoint. 97%. That means if you're sitting here in this virtual room, there's about a 3% chance that you're doing everything you can to pay as little tax as possible. I don't know about you, but I don't love those odds. And even more alarming, 76%, almost over 3/4, paid double the tax they should have been paying if they were doing everything they could to pay as little tax as possible. Double. That means if their tax bill was $20,000, it could have been $10,000. If it was $200,000, it could have been $100,000. If it was $2 million, it could have been $1 million. Double the tax. And, it's not how much you make, it's how much you keep that ultimately drives your financial freedom and business success. And that's also why tax planning is so important, because it's when you save money. This is something Damon John told me a couple of years ago. We did a webinar together, and he said something really powerful and insightful. And he said, the reason I reached out to you, Tyler, and that I wanted to do this webinar is because tax planning is so important. Because when, let's say you have a 20% profit margin, we're going to talk about margins and stuff tomorrow, but let's say that means if you're running a $500,000 business, you're bringing $100,000 to the bottom line. If you want to increase your profits by $10,000, that means you have to go find $50,000 of new business in revenue to increase your profits by $10,000. Or you can do a couple little tweaks like we're going to talk about later today and save $10,000 in taxes. You don't have any more work to do, no more cost, and it just saves you money. That's straight to the bottom line. So it's absolutely critical that you have tax planning in your calendar. And to kind of illustrate some real life examples, we did this for one of our clients, went through our process, Lisa Collum. She owns a curriculum company called Top Score Writing. And when Lisa came to us, she was 36 years old, a mom of 4, and was running, her business was really starting to take off. So obviously she didn't have a ton of time at night to read the tax code. So we went through our process with Lisa. We identified that we were able to save her just over $120,000 in taxes in the first year working with us and every year going forward. And Lisa was really smart. You see, she didn't just take that money and go spend it on a bunch of fancy vacations or buy a bunch of fancy new stuff. She started investing that about $10,000 a month in savings. Some of it in investments, others was hiring new people and to scale her business. And so think about this. This is where it gets really exciting. Without Lisa increasing her income a dollar, without reducing her expenses a penny, just from doing tax planning. And we fast forward and invest her money over, she's 36, so she retires at 70. She's going to have almost $35 million available to her for retirement just from investing her tax savings. That's without lifting a finger on any more extra work or growing her business at all, which, by the way, fast forward a few years and she's grown massively. And so that number just continues to increase because as her business grows, we're able to save her even more. So 35 million, how good would it feel to have $35 million available to you in retirement just from investing your tax savings? Pretty good, right? Now, if you might be in a situation, you're like, Tyler, this is great, $120,000 in savings, but I don't even have $120,000 in taxes, not even $120,000 in profit. Am I at a point where tax planning is something that I need to be doing with my accountant and having on my calendar? And so I want to share the story of Brian Nabavi, the CEO of a e-commerce company called Till You Collapse. He came to us. He was starting to scale, starting to get to the point where he could take a regular paycheck out of the business and getting close to 7 figures in revenue. And he was still doing his own tax return because he wanted to save money on tax prep fees. And Brian and I still laugh about this, but when he came to us, he was literally forced to because he was trying to buy a home, and the lender was like, I can't qualify you on self-prepared returns. You need to have a CPA look at this. And so we went and we prepared his returns, but while we were at it, he was only a few years in business. So we looked at his first 5 years in business, and it turns out that Brian had overpaid on average by $40,000 per year in the first 5 years he was in business by saving a few bucks on tax prep fees and tax planning. Now, I don't know about you, for those of you who are still in your first 5 years in business, or for those of you that are further along, we can still remember your first 5 years, how much would an extra $40,000 per year of cash flow help with getting that business off the ground a little faster? Just a little bit? Yeah. So Brian learned, he was thrilled to start saving money moving forward, also a little frustrated, but learned a very valuable lesson, expensive lesson that day. And that lesson is this: the best time to do tax planning is actually before you have the income, or before you start the next company, or before you sell the business. Because once you've earned the money, once you've done the thing, once you've sold and signed the dotted line, yes, we can make a few tweaks and optimizations here and there, but your tax bill pretty much is what it is at that point. So you want to meet before you earn the income so that we can have your income go like this, straight up, and your tax bill stay the same or even go down compared to not doing any tax planning. And so that's the power of tax planning. It truly is one of the most impactful things you can do in your business. And so now, when I get into some actual tax strategies that you can start implementing today, these are some of the most common kind of low-hanging fruit things that you can do to impact your tax bill if you're not doing them already. So the first is to form a sub-S corporation for your business. And what this is going to do is get rid of something called self-employment tax. And it can save you up to almost $17,000 per year on your self-employment tax. And so what self-employment tax is it's your portion of Social Security and Medicare as a self-employed individual. So when you've had if you've ever worked for another company and gotten a W-2, and you look at your pay stub, your salary, your take home isn't your salary, right? So if you look at your pay stub, there's an amount taken out for income tax, and then Social Security and Medicare. And that Social Security and Medicare combined makes up a little over 7.5% of your wage. Then your employer matches that and sends a little over 15% to the IRS in the form of payroll taxes. Well, when you're self-employed and on your own, working as a 1099 or just having your own sole proprietorship, there's no one to withhold that first 7.5%. There's also no one else left to match the second 7.5%. But guess what? The IRS still wants their 15.3%, don't they? And so you're left holding the bag for that full 15%. And that's from the very first dollar on top of income tax. You'll break even on Social Security at a net income or a wage of around $50,000 per year. Everything above that only less than a quarter of the tax you pay goes into your actual Social Security account. The rest goes into kind of other people and the Washington fund money fund, if you will. So what you do is you form an S corporation. You pay yourself a reasonable salary. S corporation profits are not subject to self-employment tax. And so you pay yourself a reasonable salary. So in this case, let's say you make about $170,000, which is where the cap on self-employment tax phases out. If as a sole proprietorship, you'd be paying almost $26,000 in self-employment tax on top of income tax. As an S corporation, let's say we determine that your reasonable salary for for what you're doing in the business is $60,000. The only amount you pay 15% on is that wage. So you end up, instead of almost $26,000, you have a little over $9,000 in payroll tax. And then the rest you get as a profit distribution, just like you would if you were owning shares of a big company on the stock market. And an S corporation is what's called a pass-through entity, which means it passes through to your personal tax return. And so you pay tax on the profits of the business, whether you pull the money out or not. There's no corporate tax. And so when you pull that money out, there's no extra tax. You pay tax once. Whereas a C corporation, you pay tax at the corporate level. And then when you pull the money out as a dividend, you pay personal income tax too. So you get hit twice. So that's if you've ever heard the phrase double taxation. And so that's where an S corporation can make a massive difference. And side perk, you're actually way less likely to get audited as an S corporation than you are as a sole proprietorship. So as a sole proprietorship, you have about a 2 to 2.3% chance of being audited. As an S corporation, it's 0.2%. And the IRS just laid off a whole bunch of people. So I've got to imagine those audit rates are going to be decreasing even more. So that's the S corporation. And you want to make sure, I have a golden rule of tax planning, and that is any strategy that you do, you want to make sure that the benefits that you receive from it, aka the tax savings, are greater than the cost of doing it. So with an S corporation, you have a little extra cost, no extra work. It's one extra tax return, which your accountant will do for you anyways. And you have the extra cost of the tax prep fees, and then a payroll provider to run your officer salary if you're not already paying payroll and don't have employees. So the break even for forming an S corporation versus just operating as a single member LLC or sole proprietorship is $60,000 of net income. And you want to make sure you're also paying yourself a reasonable salary. The biggest way to get audited is to not have an officer salary subject to that 15% payroll tax. So you want to make sure that you review the Department of Labor in your state or salary.com or some sort of comp guide to make sure that you're paying yourself a reasonable salary to do this. And by the way, if you want to just instantly save money this year, if you've already been operating as a single member LLC, meaning an LLC, but you haven't made an election to be taxed as an S corporation, you can make a retroactive S corp election back to the beginning of the year and receive the benefits of the S corporation for the entire year, rather than just starting it now and losing out on the savings of the first 3 months of the year. Now, if you haven't formed an LLC, you can't do that. But if you already have the entity in place, you can't go back in time and create a new entity, but you can go back in time with the S corp election. All right, so that's the S corporation. Next, the Augusta rule. So this is if you own your home, you can rent your personal home to your corporation for a shareholder board meeting. And you can rent it up to 14 days per year, tax-free is the rule. And it became known as the Augusta rule because every year when the Masters golf tournament comes into town in Augusta, Georgia, all the people who live there clear out of town because they could get a pretty penny renting their homes out to the mega wealthy and all the celebrities and golfers that come into town for that event. And so someone went and greased the palms of Congress and said, hey, if it's less than 14 days per year, we're not really in the business of renting if it's our home. Can we just get the tax free? And so that's where that came about. And so what you can do to take advantage of that is hold that monthly shareholder board meeting. So once a month, there's 12 days. And then if you do a bonus 2-day meeting, 2-day planning day in the middle of the year, and then another 2-day planning day at the end of the year for your mid-year and annual planning, then that gets you your 14 days. And you cut a check from your business account to your personal account. It's tax deductible as rent expense to your business. And then it becomes tax-free rental income to you. And so kind of some T's to cross and I's to dot on this side of this strategy is number one, you've got to have an office outside your home. Some people that are on the more aggressive side of things will tell you can do it if you have just a home office. But in my mind, if your business is your home office, then then you're using it for your business more than 14 days a year. So it's hard to justify that. So you want to have an office outside your home. It's got to be a reasonable amount for rent. You can't just make up, and do $25,000 per day if your home is worth $300,000. So what's reasonable? Well, if you want best practice, what you can do is find a few conference rooms at hotels or wherever in your area, in your town, that are similar size to your home and see what they're going for renting for a day. You call up 3 or 4 of them and then take the average of that. Or kind of back of the napkin rule of thumb that we've found is a pretty good number is about 0.1 to 0.2% of the value of your house. So if your home's worth $500,000, that would be somewhere between $500 and $1,000 per day per meeting. So $1,000 times 14 days is $14,000 tax-free out of your business. That's not bad. And then documentation is key. So you want to document the agenda and the meeting minutes and the items that were discussed at that event or that during those days. And then of course, you don't want to just write it off by journal entry, right? You got to actually move the money. So physically write the check, or you can make an electronic transfer and transfer the money to your personal account. And so you want to document that. And then you 1099 yourself from your business as well. And then you report on the Schedule E, and that's details that your accountant can worry about for you. But that's how you implement the Augusta rule. So here's kind of the flow of money for those of you who kind of prefer a more visual explanation. So you've got your business, and then you've got your personal bank account. You transfer the money. It's deductible as rent expense, like I said, and then that becomes tax-free rental income to you. Feel free to take a screenshot or a picture of that, and we'll have the recordings up of this as well. All right, so we've talked S Corp, we've talked Augusta rule. Next, I want to talk about getting your kids on the payroll if you've got children that are under 18, because you can get up to, and this is actually up to $15,000 now. The number just increased at the start of the year. So you can pay your kids up to $15,000 per year, tax-free per child. We had one client that they had 9 children, and they were putting them all to work. And this was a very large, a 6-figure deduction for them. Saved them almost enough to buy back the therapy that got their sanity back from having all the nine children, right? So how does this work? Because there's a lot of people doing this the right way, and then there's also a lot of people doing this the wrong way. And so I want to teach you the right way to do this. And so the right way is you want to pay them from a sole proprietorship. And if you pay your under 18 child from a sole proprietorship, they are exempt from payroll taxes. Whereas if you pay them directly from your S corporation or C corporation or partnership, where one of the partners isn't the parent, then you have to pay payroll taxes on those wages. So what you do is you open up get a sole proprietorship that's a labor management company or marketing company, something whatever depends on what they're doing for the business. And then you move the money from your S corp, and I'll show you a visual of this, to your personal account is your sole proprietorship, and then you pay them. So then they also have to do something to justify the wage. You can't just write it off, right? So so it's got to be the wage that you pay them. Let's say you're paying them $15,000 a year. They got to do something that's worth $15,000 if you're hiring someone that wasn't your kid. So that could be, helping with social media. That can be maybe being models for your websites or involved in your social media content. It could be helping with admin work, right? Something to justify the salary. And by the way, you can pay them more than $15,000 per year. That's just the amount that they get tax free. So if they're truly doing something that's worth 30 or 40 or $50,000, then you can pay them that. It's just that's the amount that's tax free. But if you're in, say, a 28% bracket and they pick up that next $20,000 at 8%, then you still save 20% of the difference. And then you want to also actually pay them and give them W-2s and file payroll tax reports. Remember, document, document, document. Everything's a deduction until you get audited, right? So we want to make sure that things hold up and you're doing things the right way to get your, to actually have that deduction hold up. And again, a regular, at least monthly salary is going to hold up better in an audit than just paying them one lump sum at the end of the year or a couple times a year. Because you want to treat them like a employee. So that means employment agreement. And I don't know about you, but most of my employees like to get paid pretty regularly, right? Not just once a year. Hey, here you go. Have good luck. And so you want to make sure they look like an employee. And then if you really, really want to take it to the next level, you can contribute to a Roth IRA with their funds because that W-2 is earned income. And so normally with a Roth, you contribute with after-tax dollars, and then the money grows tax-free, and then you pull it out in retirement tax-free. If you put that money in, if they earn, say, $12,000, all of that's tax-free, and then you put it into a Roth, and it grows tax-free forever. And so that's a really cool way to set them up for future, ultimate financial success down the line and build your, sort of plan your legacy that way. So this is the visual. I promised you a visual. All right, so you got your business, and it goes from, this is assuming your business is an entity like an S corporation. And so you have your business, it pays your sole proprietorship owned by either you or your spouse, if you have one. And that can be your own personal bank account. It doesn't have to be a separate business bank account. And then you open up a bank account in the kids' names and move the money into there. And then from there, you can contribute to the Roth. They can pay for their own food, their own, private school. If you're sending them to private school, whatever, all their expenses from there, you can use that money to pay for their expenses. So that's getting your kids on the payroll. Now that we've gone over kind of some of the most common strategies on taxes, I want to kind of share 3 ways. And this is something that I shared on social media a while back, and it really took off. People were like, that's my accountant. And so I want to share with you kind of 3 ways to identify whether your accountant is working for you or maybe accidentally working for your government. Because if you don't know the tax code, you don't really know if they're doing everything they can for you. And so the first one is this. When you bring them an idea to save taxes, they look for reasons to shoot it down, that it can't work, instead of looking for ways to make it work. And yes, I understand that there's a lot of TikTok tax advice and really bad advice out there. So there is an element of helping you stay in line with what is actually legal and what's not. But it's more about the attitude with which they approach it. Let's look for how do we make it work versus nope, can't do it, right? So if they're constantly shooting down your ideas or they're not bringing you ideas, you're always bringing them ideas. Number 2, they're really nice. I know a lot of really nice accountants out there, but they don't meet with you throughout the year to plan with you. They just fill out the forms at tax time. Ladies and gentlemen, if all your accountant is doing for you is filling out the forms at tax time, like right now, a couple weeks before the deadline, I can just about promise you're leaving thousands per year on the table. And the third one is my favorite. And this is probably the one that when new clients are meeting with us, that they share the most in terms of why they were like, I'm done with this person. I need to move on. They say, hey, paying lots of taxes is great. It means you made a lot of money. Congratulations. Your tax bill is what it is. You just got to move on, cut that check with a smile on your face. It means you're successful. Good job. Pat on the back. Anyone recognize their accountant in maybe 1 or 2 or all 3 of these? Yeah. So if you recognize any of these signs, there's a decent chance that you are leaving some money on the table. And so I'd love to invite you to take advantage of a free tax assessment with my team. So to do that, you can scan the QR code you're seeing on the screen and you'll click through and you'll book it takes about 15 to 20 minutes. And we go through a series of questions to help identify what we think we can save you in taxes and what you might be leaving on the table. It's just the most common things. And there's usually more once we dig into it. And we'll tell you that number right there, what we think we can save you. And there's no obligation. We just want to see if we can provide value and help you figure out what you might be leaving on the table. And then from there, if you want to work with us, we'll share what that looks like too. This is our average tax savings, by the way. Over the last 2 years, we looked at all the clients that we worked with and the money we saved them. And based on different revenue ranges, you can see, for example, $250,000 to $600,000 in sales. Our average savings was $31,000. Someone doing 2.5 to 5 million in sales, average savings is $79,000. And obviously over 5 million is 100. So it goes up as the business grows because there's more income, there's more meat on the bone, there's more complex strategies that we can do. But if you're doing $500,000 a year in sales and we're able to add $31,000 straight to your bottom line, that's not bad, right? When you get this tax piece dialed in your business, it frees up so much resources, so many dollars to invest in whatever it is that truly matters to you. Whether that's giving a whole bunch of money away to charities and causes that are dear to your heart, or investing in growing and building a team, or going and travel in the world by yourself or with your family, or whatever that looks like for you, whatever else it might be. When you free up those dollars in tax savings, it just allows you to just totally invest in whatever it is that matters to you.